This is iBergamot with the Rate T report. This is an interesting way to find a tradable bottom, an excellent buying opportunity in stocks. In the chart, I have two plots on the same price chart. The bar chart is 30-year rates, the yield of a 30-year US Treasury, and the line chart is S&P 500 stock market for the purposes of this experiment. As you can see, the interest rates on the 30-year bonds fell from the high of 3.97% back at the end of 2013, and it fell for over a year to a low in 2015 at 2.22%, at which point it rallied. So the center post for this time symmetry will be right here in the beginning of 2015. The T theory states that it will take an equal period of time for interest rates to fall from the high to the low, as from the low to the low in stocks, not in bonds, in stocks. This is the way to find a buying opportunity in stock market. Rate T projections are not exact. There always has to be allowed some kind of a give or take about 10%, and in this case 6 weeks, which minus 6 weeks is exactly the low in February of 2016, and another low that projects is the sell-off right before Brexit, which was also pretty good buying opportunity. In retrospect, the market rallied quite significantly even since that low. I want to point out a couple of interesting things about that. So this rate is complete. We cannot gain any more information from it, but we can learn an important lesson. For example, there were multiple highs in interest rates. This one, the highest high, and also this last high in the last week of December of 2013. At some point during the week, it looked very bullish. It looked like rates going higher, but then they reversed. So we have first high, highest high, and the last high. And then as rates begin to come down, I want to have some kind of a threshold to figure out which one is the low actually. So what I would do is I would look for significant correction. Like this correction was almost 10%. Okay. So obviously this is more. We can say that this was the top even in real time. That this was getting toppy. Minus 12% is the top. Alright, now we're looking for tradable low. Here's what I do. From this low in interest rates, it rallies 7.5%. Not close to 10%. Not bottomish enough. Then from this low, that's about 10%, 11. So this is a good low, and well, I don't need to tell you. I don't need to tell you that this was an important low. This is definitely a panic low in interest rates. There was a lot happening back then with the futures contract on 30-year bonds. It was a strange period of time, but there was something, and that was tradable. So that's definitely a low, and it rallied more than 10%. And then this one, it definitely more than 10%. Let me put a measure on it. This one rallied off the low by 30%. And then just a little bit later on it made higher highs, so this is definitely the lowest low. So we have 3 highs, 1, 2, 3, and 3 lows. Now, T's, the equal time symmetry measurements, can be constructed in a variety of different ways. If we have these 3 lows with green lines, and we have 3 different highs. The first high, 0. The first high, highest high, last high. That's 3 of them. And all the T's go in the same color. You can see that some of them pick even earlier lows quite accurately. In fact, two of them come in on a drop in fall of 2015, and that was quite a drop, and it produced a tradable rally which I traded, made my whole year, this 20 days. That was all the money I made in 2015. And these T's, they go in a strange kind of a way. Some of the best ones are from the first high to the first low. So that would be first high to first low, this one. That's the first low. And the measurement of that came in the first bottom. And so is the highest high to the panic low. See, this is the panic low. And that one measured into the same bottom again. And then this one from the last high to the last low, that measured even closer to the ultimate low in February of this year than the standard T that I showed in the classic example. You know, that one that still goes plus or minus 6 weeks. And listen, if you put plus or minus 6 weeks on any of these target dates, it will cover pretty much this whole entire period. And this is my point. Ray T allows to forecast ahead of time when the volatility will increase to create a tradable low. Each one of these drops was literally just a few days. It looks like it took weeks and months. It was the bear market that started, you know, on the S&P average in 2015, but really it started in 2014 in December. And it dropped much more than the S&P 500 index shows. Most stocks dropped much more. So this was very important low, an excellent buying opportunity, a multi-year low, and I think a very durable bottom that will stay for quite some time, which could have been not forecasted. This is not a forecasting tool. It doesn't provide exact it doesn't tell you what to do right there and then, because this is, you know, a whole bunch of different measurements. Each and every one of them is some kind of a buying opportunity plus or minus 6 weeks. But if you sell out before it starts, then the trader will have sufficient funds, maybe some cash put away, in order to do the buying when these lows get hit. Thank you for listening.